Now we're going to talk about annuities. An annuity is just something you buy. It's a financial instrument. So there's no tangible item you buy. It's just really a contract between you and some sort of financial institution, usually a brokerage of some form. So what you do is you give the brokerage a certain amount of money, and it can be whatever amount y'all agree upon. And in return for that, the brokerage agrees to do a couple of things. Maybe they'll pay you a certain amount per month for the rest of your life, or maybe they'll guarantee you a certain rate of return on your investment. And so these items are taxable, but you are allowed to recoup what you pay for it tax-free. But the way you recoup that tax-free portion is very convoluted. The IRS has made it difficult. If you remember from principles of accounting, the matching principle, we try to match the revenue with the expenses that were expended to earn that revenue. So we try to put them in the same period. We don't want to have $1 million of income in January, but then all the expenses that we spent to earn that $1 million show up in February, because then January we'd have a huge profit, February we'd have a huge loss. So we match them up together, usually by accrual. And so that's kind of what we try to do with annuities. We don't want to just deduct the full cost of the contract up front, because then we'll have zero income for a few years and then a big jump in income for the next few years. So we try to take little bites of it as we go along through the annuity life and recoup some of it tax-free. Luckily nowadays, most brokerages track all that for you. So you'll be relieved to know I'm not going to make you calculate the tax-free portion using one of the two methods, because nowadays it's usually done for you. And so there's really no need to do it. And you're not going to have to worry about it for another 50, 60 years when you guys retire. So you'll probably have forgotten it by then anyway. So let's just focus on how annuities work. So let me share my screen with you and we'll take a look at that. All right, so like we talked about, annuities is just something you buy. It's like I said, it's just a financial contract you buy that gives you the right to receive certain payments in the future. And again, it could be a certain amount per month. You might give a company $50,000 for the right to receive $1,000 a month for the rest of your life. Or you might give them $50,000, and in exchange, they agree that you're going to earn 6% on that $50,000. So that's the two common ways to do it. And then, of course, how they pay it back to you is really, again, just a part of the contract. They might pay you the interest every quarter. They might pay you a payment every month or every quarter or once a year. It's just kind of whatever you guys work out. Now, of course, you really don't get much of a say in it. The companies have certain contracts that they try to sell. And so they'll tell you, we need $75,000 and you will get this. And if you say, well, I only got $40,000, they'll say, well, you can't buy this one, but let's look at something else. So they can generally make it work for you. Annuities are very popular with retirement people because, especially the ones where they pay you a certain amount per month, because you have no idea how long you're going to live. And most annuities will include the life of your spouse. So you and your spouse can kick in a big chunk of change and get a guaranteed payment for the rest of your lives. And so that is a big plus to retired people who are trying to prepare for the uncertainties of when they may die. Of course, the way annuity companies make their money is to get a certain payment per month is you usually kick in quite a bit of money. So to get a decent amount per month, you might have to kick in $100,000 or $200,000, and they'll agree to pay you that a certain amount for the rest of your life and your spouse's life. And of course, what they've done now is they've taken that lump sum and they're investing it and they're earning money on it. And they're really hoping they can make a profit over what they have to pay you. And they are also hoping you both die real fast, because once you buy this contract, it's only good for your life and your spouse's life. And so if y'all buy this contract, get your first month payment, and then the next month y'all are killed in a car crash, it's gone. There is no recourse to get any of that money back. Now, some contracts do have some sort of guaranteed amount that if something like that did happen where you were killed right away, then your heirs would get a certain amount of money back for it. But a lot of them it's just over. When both of y'all have passed away, it's just over. The amount you paid, which is called your basis, can be recouped tax-free. And deducting basis is something you'll hear a lot in the tax community. You subtract your basis when calculating your gains for capital gains. You subtract your basis for determining how much gain you have on the sale of your house and whether or not it goes over the exclusion or not. So basis is always a big number you always got to know about. And usually basis is just the amount you paid for something. There are some additions to that and there are some subtractions to that, and we'll talk about those later on. But in something like an annuity, the basis is just going to be what you paid for it. So there's two methods to recoup your basis. The simplified, which is the most common one, it's the newer one, and the general rule. But both of these basically just take the amount you've put into it and they divide it up by your lifespan, and they give you some sort of fractional amount, and they can determine that this much is going to be earned tax-free every year. But like I said, most annuity companies will report this to you on a 1099-R, and a 1099-R is just like a W-2, where box 1 will tell you the gross amounts you were paid, and box 2 will now tell you the taxable portion of how much you were paid. So in reality, you're probably not going to calculate this anymore. The annuity company is going to do that for you. And then anything over what you're recouping is absolutely taxable income to you, because it is money you've earned that you didn't pay for, and so it's going to be taxable income to you.